There is a hidden housing market crash happening right now, and while many people seem to be unaware of what is unfolding, the real estate market has entered into panic mode, and what awaits us over the next few months is a disaster that could be worse than what we saw in 2008. Now, what we have to understand is that there are several key components that you need for the housing market to collapse, and those components are gradually aligning themselves to indicate that a major drop in the housing market is imminent. Now, the first of these components is home builders and what they are doing with new homes on the market, and it is becoming clear that they are panicking right now. The number of new homes for sale coming from home builders is surging at a scary pace, and since the summer of 2020, supply has basically been heading upwards vertically. We are now at highs of 511,000 brand new homes that builders are trying to offload onto the market, which is the highest that the supply has been at since 2007, at the peak just before the big crash. And in the south region specifically, the problem is even worse as supply has now surpassed the 2007 peak and is now at new all-time highs. Now, just like during the global financial crisis period, we are seeing an extremely similar trend take place where supply during both periods ran up extremely high and basically doubled over a period of several years. When adjusting for the number of months of supply that this is, it means that home builders have a whopping 9.8 months of supply that they need to offload, which is a concerning number given that levels this high typically correlate strongly with recessions. Now, home builders are desperately trying to get rid of these excess homes by offering all sorts of new buy incentives, ranging from buy downs, cheaper special interest rates on mortgages, quick move-ins, and slashing prices. And this data from John Burns research clearly shows how incentives as a percentage of revenue for various large home building companies has been rising over the last few years. Home builders are now having to offer high single-digit percentages of their revenue for incentives, a vast sum compared to the sub 2% that we saw at the beginning of 2022. And looking at Lennar Corp, who are one of the big two home builders in America, we can see that incentives as of the latest quarter are now at a whopping 13.3% and haven't been this high since 2010. The CEO of the other big two home builder, D.R. Horton, has warned investors that incentives could only continue to rise, saying, "Despite volatility and uncertainty of the current economic environment, we expect our sales incentives to remain elevated and increase further during the fourth quarter." Now, having a lot of supply to sell to the market wouldn't be a problem for these home builders if the market was thriving and demand was plentiful. However, this is not the case at all right now. Existing home sales have now fallen to lows that have not been seen since the global financial crisis, while pending home sales, a leading indicator of home sales that measures contract signings, just reached an all-time low. Now, the continuing decline in both of these metrics signals just how weak buyer demand is getting, and is another key component of the next housing market crash, as it is causing the gap between the number of buyers and sellers to grow. We can see that the number of buyers declining over time means that there are now more than 508,000 home sellers compared to buyers, which is the largest gap ever recorded. The simple reason why there are so few buyers in today's market is that the cost of buying a normal house on a normal household income is just so unaffordable that it is driving so many would-be buyers away from the market, as it is just not a realistic goal. And although we are starting to see house prices cracking, the median home sales price is still at $410,000, which is only a 7.2% decline from the absolute peak that we saw in summer of 2022. And even then, these prices are still a whopping 29.5% higher than the prices that we saw at the start of 2020, while over the same time period, the average 30-year fixed-rate mortgage has more than doubled from being around 3% in 2020 to now being in the mid-6% area. Now, this double whammy of home prices as well as mortgage rates both soaring over the last 5 years means that monthly mortgage payments on a median priced home are now at a staggering $2,800 a month. Now, these mortgage payments have vastly outpaced wage growth, and means that the affordability index, measured by the ratio of housing cost to income for a median priced home, is now above 40%, which is at highs not seen since the 1980s. Households are being driven to breaking point, having to sacrifice a higher percentage of their income every month to own a house than at any other point in recent history, and it is the reason why many are walking away and not seeing home ownership as an option right now. On top of this, people are becoming more fearful about the state of the economy in the future and growing more concerned about losing their jobs and being unemployed. The CEO of another major national home builder in America, Pulte Group, said, "Feedback from would-be homebuyers indicated a variety of concerns ranging from affordability and the inability to sell an existing home to a slowing economy and the fear of potentially losing their job." We are seeing some concerning jobs market data emerging in recent weeks, with the new jobs numbers falling vastly below expectations, while previous months' numbers have been revised downwards at unprecedented levels. Meanwhile, the number of people unemployed is steadily rising as more and more people are either being laid off or simply withdrawing from the labour market. Now, this data is a bad leading indicator for the housing market, because if we do see this trend continue, potentially even leading to a full-blown recession, then we are going to see foreclosures and delinquencies on houses rise, which they have actually already been doing slightly recently, and also buying power for new prospective home buyers will weaken as well, with household incomes being lower on average. Now, with the housing market clearly broken right now, with there being a glut of supply coming onto the market, demand at an all-time low, and affordability the lowest that it has been in 50 years, all signs are pointing to a major fall in home prices. Now, this great housing affordability matrix from Reventure app does show that even if mortgage rates were to fall by a full percentage point to 5.6%, it doesn't really move the needle on affordability. And even if mortgage rates were to be absolutely slashed to 3.6%, levels similar to what we experienced pre-2020, something that is extremely unrealistic to happen anytime soon, if ever again, then we are still looking at a monthly mortgage rate of around $2,200 a month. A 30% drop in house prices, however, can happen in a relatively short space of time and would bring median mortgage payments below $2,000 a month immediately. And I think just looking at this matrix really does show very clearly how important house prices are when it comes to affordability, and although mortgage rates do matter, sellers can begin to find buyers for their homes simply by cutting prices. And I think that this is what we're going to see take place in the housing market over the next year or so to neutralise the supply-demand imbalance and for desperate sellers to find a buyer for their home, as well as for home builders to get rid of their ever-growing inventories. With all of this being said though, we are also seeing US M2 money supply continue to grow again, something that directly devalues the US dollar, increases inflation, and tends to increase the price of hard assets like real estate, as well as the likes of gold, Bitcoin and stocks. Now, with the government's national debt situation spiralling more and more out of control, and interest payments on this debt also skyrocketing, the government could well print their way out of this problem and continue to significantly devalue the dollar, something that has been happening throughout 2025 so far already. And if we do therefore see rapid money supply expansion and dollar devaluations continue over the next few years, then this could well inflate home prices even higher and prolong this housing market bubble for a little while longer, despite affordability being at historic lows right now. But it's also not just the housing market which is beginning to show cracks, and as I mentioned earlier, there are now a number of major indicators flashing red that a major economic decline is coming. And this may not just be a normal recession, as something that many economists like to describe as the worst case possible scenario for the economy could well hit soon. Now, I cover this topic in more detail in my previous video, which you can check out by clicking on screen right now. Aside from that, if you enjoyed this video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.